This is the Anything But Banker to Broker podcast. We're going to be talking to some of the industry's best and brightest about the unique pathways they took before stepping into broking and how it set them up for success. Thanks for listening. Hey everyone, thanks for jumping on and joining us today. So I've got someone very excited on, Simon Lewis, who's got a really exciting venture that he's just launched. We're going to cover that off a little bit later on. But before we get into that, Simon, how are you getting on, mate?
Very good, thanks, Joe. Happy to be here.
Beautiful. Thanks for jumping on. I know there was a bit of back and forth between us and should I get you to come on, but I think with everything that you're building, I think it's a really perfect time for you to do it.
Thanks, mate. Appreciate it.
Yeah. Now, up until doing this, there's been a very interesting story. You know, it's not your first business that you've launched. You've done something else completely different in the past that we've also caught up on, and I was a huge fan of that. So I'm sure we'll get into that too. But before we get into anything, you obviously have your uni degree. Talk to me about your days prior to uni. What were you doing?
Well, while I was at uni, I did every job under the sun. So, I was just trying to scrape together enough money to go out that weekend essentially. And because you've got the sort of, you didn't want to be tied down to anything, or I certainly didn't. So I would jump at anything. Mate, when I knew festivals were coming, I was living in Melbourne. When I knew festivals were coming to Melbourne, like Big Day Out or Laneway or something like that, I would just turn up a few days earlier with a high-vis vest and just ask if I could work in exchange for a ticket or in exchange for a little bit of money. I delivered juice for Emma and Tom's, which is a juice company that's still going down in Melbourne. And I actually had one of the worst days of my life working for Emma and Tom's. I was delivering juice in the city and I've parked in a loading zone. I've jumped out of the van, just grabbed a couple of 6-packs of juice, run in to do a delivery. And when I've gotten back, I've realized that I shut the door of the van onto my seatbelt, which meant that it didn't lock. And you got to be quick in Melbourne CBD, and someone was quicker than me. And they've just cruised past, grabbed my pencil case full of cash that I'd been collecting from all the vendors that I'd dropped off the juice to, and disappeared. And so I've jumped back into the van being like, oh geez, the door wasn't locked, but hopefully everything's okay. Looked around, looked in the glove box, damn, the pencil case is gone. And that was just like that was a real low point. And like looking back, I would handle it very differently now than I did back then. I basically just called the boss straight away, explained what happened, apologized, but I never offered to either pay them back. It was about $650, or I never offered to work it off. And so it was just kind of this awkward situation where the boss was like super livid that I'd lost all this money. And then eventually it didn't end up working out there. Had another experience working for Snooze, which is a bed shop, delivering beds. You can see that most of these jobs don't end too well, and there's a bit of a theme. I think there's a lesson in this. I drove all the way. I drove like 2.5 hours out into Gippsland in Victoria to deliver this like glass sideboard. Anyway, I've delivered it to the guy. We got into his house, put it in place, and then on the way back, I've gotten this call from the boss, and they've said, "Oh, the glass sideboard is smashed." And I was like, "It was perfectly fine when I saw it there." And the guy's telling me, the customer has said it's smashed. He's not going to lie to me. What have you done? Anyway, and then I had to drive back, collect it, bring it into the shop. Total disaster. But I suppose the theme is, I had fun doing all these random jobs while at uni. But when you're not focused on something, and when you're doing something purely just to get a little bit of cash so that you can go out and so that you can live your life as a student, you don't basically produce a very good result. And it becomes super awkward between you and your employer. And, I think, or I hope I learned some valuable lessons. So then basically when I finished uni, I was chomping at the bit to get a full-time job, have regular pay, and just devote myself to something and go to an office 9 to 5, give it my all, meet people and embrace it. And that's what I did. I got my first job at Stratton Finance, which is still a car finance company, still going really well. And it was a fantastic place to work. There was a scoreboard on the wall, so everybody knew how many sales they were getting. It was really competitive. We had, I think, 3 or 4 massive table tennis tables, and it was just on at lunchtime. It was like a table tennis tournament every single day. I think the only downside was that because it was my first proper job, I didn't realize how good I had it. And so, sometimes that can be a bit of a trap as well. And you need to go and kiss a few frogs before you realize that, you've already got a princess. So, that's a little bit about my early work history.
Yeah, thank you, mate. It's one of them, I think I've had that same experience, right? When I moved out here, I was post-uni, early 20s, like every job I did was a means to an end, and that end was having a bit of money so I could go and enjoy the sun and do whatever. But you're
Yeah,
right, there was so like if you looked at my resume that I didn't have to narrow down, there'd be so many things on there, call center jobs that lasted a week, all sorts, because the means to the end was what I needed, but you're not devoting yourself to anything, right? So what I'm trying to say is, mate, I don't think that is a Simon Lewis problem. I think that's a early 20s, needs a bit of direction, hasn't kissed any frogs yet, sort of thing.
100%. Yeah.
Yeah. So Stratton's where you got your real start in finance, essentially. Was it you kind of really finding your feet and finding something that you're passionate about?
Yeah, it was brilliant. I mean, I liked lending from the start, and I liked the finance industry. I like cars as well. I stayed there for about a year, and I ended up getting a job at ANZ in the private bank. And I thought, oh, this
Mhm.
is probably going to broaden my horizons a bit more. I can learn a bit more about lending, about investing, and have a sort of a big brand attached to me. I'm sure many of the listeners have worked in a big bank, and it's in some ways it's not all it's cracked up to be. But that was a good experience. I think I needed to do at that stage of my life.
Yeah, I've had the chats with a few younger people that have never worked in a bank and they want to get into broking. And most of the times that conversation goes down the path of, look, I think you need to go and try the bank for a year, because
Mm.
if you don't do it, there's always going to be this lingering thing in the back of your mind that you want to do it or you want to try it. But yeah, I think you really have to get into it.
Mm.
So founder energy is something that you obviously have because you started your own business. That was, let's call it this, your meaty cut away from finance, let's call it. Yeah, do you want to give me a bit of a rundown on how that started and what the whole operation was?
Yeah, sure thing. So I started an online meat delivery company called McKenzies Meats. It was very much a passion-driven business. I thought, there should be more options for really high-quality grass-fed meat delivered to your door. And I'd seen the success of Butcher Box in America, which is a massive company that's been a huge success. And I thought, oh, we should have an Australian version of that. And so I jumped straight into it, learnt e-commerce, learnt marketing. Obviously, there was a big logistical component as well, delivering all this meat. And it was an adventure. And, I managed to sell a lot of meat. In a good month, I'd sell 60 grand of meat, send it all around Sydney, and yeah, taught myself e-commerce, really threw myself into it. After a sort of 2.5 years, I realized, okay, this isn't the business for me long term. It's a very difficult game. The margins are slim. All sorts of things can go wrong when you're dealing with logistics and delivery drivers and that sort of thing. And fortunately, a good friend of mine, Tom Rolfe, who was running a company called Bondi Oysters at the time. So he was doing a similar sort of hustle, delivering oysters all over Sydney. He would absolutely boom on things like Valentine's Day or New Year's Eve, because he was also delivering alcohol too. We were good friends, and he said that he wanted to acquire McKenzies Meats, and so I ended up selling it to him. So look, I learned a lot of really valuable lessons running my own business, and running what I would deem to be a very difficult business. First of all, e-commerce isn't easy. And then retailing something like meat, where the gross margins are about 30%, and then you're trying to get a net margin of 15%, but doesn't leave much room for spend on marketing, customer acquisition, things going wrong. So it was definitely a challenge, but I'm glad I did it. And I think, as a business person, I'm better off having dove into that initial business.
Just to confirm, your previous experience and you not being the best delivery driver, you weren't actually delivering the meats yourself.
No, most of the time I wasn't. I had a team. I did my fair share of deliveries though. And I think being a little bit more mature and being a bit calmer on the roads was definitely an advantage. Didn't take as many risks.
So would you say this because this model's taken off, right? So there's lots of businesses doing it now, and
Yeah.
we've spoke in the past that I've looked into doing it myself, not setting it up, obviously being a customer. Was you one of the first businesses doing that? Is that where it sort of evolved from over here?
Yeah, absolutely. I was one of the first. And now you've got Butcher Crowd and Our Cow, who are two big brands. And also McKenzies Meats has really grown. I spoke with my mate Tom yesterday, who's running it now, and he's added an extra $1 million worth of revenue in the last couple of years. So he's seen an uptick there, and he's doing a great job. But yeah, I mean, now it's very normal to get things delivered. But if you look back about 5 years ago or before COVID, it wasn't such a thing, and we saw Milk Run burst into the market and do a huge volume of deliveries and revenue. So yeah, look, it's a real thing now, but it wasn't so much then. It's still a very challenging business, but it's been more normalized now.
What was your biggest learn lesson from really building something from scratch there?
Look, I think my biggest lesson is that there are easy businesses and there are hard businesses, and then there are many in between. And it's really important the vehicle that you choose as a business model. And since coming back into finance and working closely with brokers, I can see that the mortgage broking model is certainly a lot more attractive than an online meat delivery company. The mortgage broking model isn't perfect, but if you think about how much you make from doing one deal, let's say the average loan size is 800,000 and you're getting a 0.6% upfront, you're making $4,800 just from doing one deal. Plus you might make about $1,200 in the first year in trail. So it's a $6,000 ticket essentially that you're riding in the first year. You got to sell a lot of boxes of meat to get that $6,000 ticket. And with a $6,000 ticket, you can spend, depending on your systems, you might be able to work back and say, look, I can spend $2,000 acquiring each customer, and that's a worthwhile investment, and I'm still making profit in my business. So those sorts of economics are attractive. And, you see some brokers in the industry who've got fantastic niches. They've got great referral partnerships. They've got a really consistent way of acquiring customers. That works. And that's why some brokers are so successful. So that's really one of the big lessons, the actual business model. There are a couple of others as well. In the end, I ended up selling my business to a close friend. And this close friend, we had been business buddies for about 2 years before I sold my business. We actually met in quite an unusual way. I was very randomly told that I looked like Hamish Blake, the comedian. And that led to me going on tour with Hamish and this whole crew for Tourism Australia. And so we did this amazing trip where we went around Australia and I was his fill-in to help set up the shots, or if they were shooting from behind, they'd shoot me instead of Hamish so that Hamish could sort of be in two places at once. Anyway, my mate Tom was on the film crew. So he was at the time, he was a professional in the film industry, and we hit it off because we had these two businesses that were so similar. Anyway, we would catch up every couple of weeks for a coffee. And so the whole way through, Tom knew how I was running my business and he knew how it was progressing. So then when I said to him after 2.5 years, hey, I'm thinking about selling this thing, he straight away said, well, I'd like to buy it, because he knew how I'd been running it. I sent him over some numbers and we were able to do a deal. What I'm trying to say there is that forming relationships within the broking industry, letting other brokers know how you're running your business, letting them know how well you're doing, leaning on them for advice can be really beneficial, because it's a guarantee that at some point you're going to sell your business, but it's not a guarantee what sort of outcome you're going to get. And we know that in broking, people are selling their trail books for between 2 times annual recurring revenue and up to 4 times. So there is this massive gulf and this massive opportunity to get a really big exit versus a smaller exit, which some people who are, perhaps quiet, closed off, aren't taking on any advice will achieve. Having those relationships, talking with people, making sure that you're open about your performance, improving all the time, makes life so much easier, even if you're running an online meat business. And then the third thing is, ever since that business, I was pondering this idea of, can you deploy capital in your business and get a great return on that capital more than the cost? And what I mean by that is, in my meat business, I never considered taking out a loan, because I knew, hey, if I put $100,000 into marketing, sure, I'm going to get a lot more customers, but it's going to take so long for that to increase my bottom line enough so that I can comfortably pay back the loan. I might get an uplift of, say, 20 or 30% in the first year, but that's probably not going to be enough to comfortably make these loan payments. And that was same with taking on an equity partner, which I did consider. I was in talks with some fantastic guys who wanted to buy 50% of the business. And when we were talking about a valuation and we were talking about how much money they were going to put in, the numbers just weren't appealing. These guys wanted half the business. They weren't going to put in that much. They had all sorts of expectations for me to do. The difference in broking is that because your business is it's easy to value your business because it's generally a multiple of trail, and it's easy to deploy money because if you can acquire more customers, as I said before, you're making 6,000 in the first year on each customer on average, you can get that instant return. So you really can deploy capital to grow it, whereas in my meat business, you couldn't. And that's sort of an idea and an understanding that has evolved over time. You want to look for a model where you can pump money in and quickly grow it. Otherwise, you're sitting around hand-to-hand combat, acquiring one customer after the other, hoping to organically grow. And when you've finally got a little bit of money, well, then you can maybe employ another person part-time. You don't want to have to wait around for that. You want a business where you can put money in and really supercharge it.
Yeah, and I think before we talk about the new business, I think what you said there is really important, right? You can chuck 100K into marketing,
Yeah.
and you're waiting however long it might be to get that back. You could chuck $100K, 80K at bringing a para broker in or a loan processor into the business, right? And that doesn't come out of the bank straight away. That goes out across the whole year. But what does that do for the business? That frees up the founder or one of the brokers or whoever's bottlenecked, it frees them up to actually go out and direct market themselves, right? So what you've said there, deploying capital in the business, the return on investment in a broker business is so much more valuable. So let's talk about Broker Capital, which is the new venture, which you're essentially going to be helping brokers do just that.
Exactly right. Yeah. So in the broking market, we're seeing it mature and we're seeing it consolidate. And what I mean by that is that brokers and their books are becoming more and more valuable. It's becoming an asset that is liquid. You can easily sell a trail book. It's becoming an asset that's valuable. As I said earlier, we're seeing some books trade at as much as 4 times, and there's a lot of consolidation going on. So essentially it's harder to survive as a small operator. And so we're seeing people partner up. We're seeing, medium-sized businesses buy smaller businesses. We're seeing big ones buy medium and smaller businesses. And we're seeing just a total maturation of the industry. But at the same time, it's still hard for brokers to get access to funding. And the funding that I'm mainly talking about is debt. So getting a loan to invest into your business for things like hiring staff, marketing, buying out partners, acquiring other books, navigating tricky situations, working capital. It's still difficult for brokers to get access to this funding. Down the lower end of the market, there are plenty of sort of payday and fintech lenders who will lend you money, but the rates are often exorbitant. And up the higher end of the market, some brokers are securing fantastic deals with big banks. Generally, the loan size is over $1 million. So if we have a look at sort of, the bell curve of mortgage brokers, most brokers are not looking for $1 million business loan. They're looking for $100,000, $200,000, $300,000 worth of business funding. And the banks just simply aren't interested in that level of the market. Also, if you go for a business loan with a bank, they're going to want to see everything. They're going to want all your financials. It's a big decision. It can take months before you're actually getting your funding. And I think that's crazy, given how much value brokers have in their trail book. And we can see it right there, simply by looking at RCTIs and your aggregator agreement. You should be able to get fast funding as a broker. And, it comes back to what we were talking about before. With that funding, you can put some fire into your business and you can really grow it much faster. And, if you have a look at the brokers who have grown super fast, a lot of them have had access to funding. That's the simple reality to it. It's like, how have these people been able to organically capture so many deals? It's like, well, they did have a bit of a secret tool, whether it was having an investor to start with, which meant that they could scale a team quickly. So they had several loan writers, they had loan processors, they had a marketing agency working for them. Those sorts of things make a huge difference and can really, really set you apart. So yeah, I think I know that there's a clear problem that brokers need access to capital, and it's not as easy to get it as it should be.
I think it's a great irony if you think about it. The most adept and equipped people to help people secure finance for their business don't struggle, but there's not them options there for them. Yeah, it's a great irony. Now, in terms of these growth levers and what people can actually secure funding for within their business, could you give me sort of like a tick list of the sort of things people could come to you for and actually leverage against their trail book and get money for?
Yeah, of course. Well, a big topic in the industry at the moment is acquisitions. And essentially every broker that I speak to who's growing is saying, yeah, I'd love to acquire a trail book. One of the reasons that they want to do this so badly is that the market is getting a little saturated and it's getting a little tough out there. And organically acquiring customers isn't as easy as it used to be. So going the inorganic route, acquiring a book of clients, which of course, when you buy a trail book, you're getting the trail, which is the recurring revenue. And often just the trail itself is a great investment. But the real cream is in buying access to the clients. And so now you have this sort of bigger book of clients that you can reach out to and that you can refinance, you can cross-sell asset finance, commercial deals. Who knows? They might be buying investment properties as well. You're just instantly growing your network. And one thing that we can help people with is with the acquisitions, we acknowledge that you've got value stored in your existing book, and we know you've got value stored in the book that you're buying. And so we'll lend across both. And so often for acquisitions, you don't need to put any of your own capital in. You just borrow it from us and away you go. Your business doubles overnight. So that's something that a lot of people are interested in, the acquisition side of things. Other uses of funds is partner buyouts. Often businesses will start with the best intentions, but life happens and situations change. And for whatever reason, one of the business partners may not want to be involved in the business any longer. This can be a very nervous time for the business owners because they've built this brand, they've got this engine, things are starting to crank, and then suddenly, oh, I've got to give half of the business away. You don't have to give any of the business away. You can leverage against the business, free up some cash, pay out that partner, and then you own 100% of the business and you preserve the asset, which hopefully is growing and is more than likely producing this fantastic recurring revenue. So that's another popular use case, and it's just the reality of life. I helped somebody recently who has become a good friend who had investors in his business. When he kicked things off, these investors really helped him out because he could pay himself a salary, he could eat while he was getting going. But after about 7 years, he's now built a massive business and he doesn't need the money that these guys put in initially. It's already been spent, but they're shareholders. So every time he pays a dividend, he's giving money to these guys. They've already ridden their ride. And so it was time for him to pay them out. He had a conversation with them, and because the book has simply gotten so big, they were happy to be bought out at a 2x multiple. Now, if this guy sold on the open market, his book would sell at 4x. So he's essentially buying these guys out at a 50% discount to him. The partners are stoked because they're getting this massive chunk of cash. They're getting a house deposit, return on what they put in initially. And it's a real win-win. His clients, his staff don't notice a thing. Life just goes on. So, partner buyouts is another one. Working capital is a pretty easy one. If you're running a business, you've got regular bills every month. Sometimes cash flow can be lumpy. We see that with upfronts. I look at brokers' books all the time. 1 month, the upfronts might be 20. The next month, they're 40. The next month, they're 60. And then they're back to 20. It's not something that we can control. Fortunately, the trail is a lot more steady than that. But some working capital to ensure that all the bills can be paid is really important. Business expansion is another one. People regularly take out loans to hire staff. For example, I'm chatting to a mate now who's a broker, and he's gotten to the point where he's got plenty of leads coming in, but he is doing everything. He's doing the business development. He's doing the initial calls. He's doing with one assistant. He's working the deal the whole way through. And he is going crazy. And it's time for him to hire a loan processor and probably to hire a broker to work in his business. And he needs to get out there and he needs to go and, stamp the concrete and spread the word about his brand and just bring more and more people in on the front end. And then his team can look after them and process the deals. So yeah, there's all sorts of examples like that. Marketing is another thing why people borrow. But yeah, having that access to capital makes an absolutely huge difference. The final one is debt consolidation. Now, as business people, we tend to pick up little pieces of debt along the way. And that might be in the form of a sort of payday or a short-term lender, like I was mentioning before, the likes of your Prospers, Maulers, Shifts, etc. Great option, but the problem is it's expensive and it's often it's a short-term stopgap. Also, ATO debt is a massive problem for a lot of brokers. During the COVID era, the ATO was very accommodating, which was a good thing. It helped people survive. It helped business stay, I won't say normal, but it helped people get through. But those days are over. The ATO wants their money back and they're putting people on payment terms that are like 12 months. So imagine if you owe the ATO 120 grand and they want it back within a year, you've got to find $10,000 after tax to pay the ATO. It's pretty crazy. Plus the ATO is charging interest. They're charging like 11.5% and it's not tax deductible. So the real cost of that is more like 17%. So it's getting pretty spicy. Anybody with ATO debt, if you're a broker, you should absolutely look to refinance that. You can go with a lender and, for example, we'll stretch it out over 5 years and all the interest will be tax deductible. So look, there's a lot of reasons why people need access to capital. It should be easy. It should not be a headache. It should be just send us your RCTIs and your aggregator agreement, and then we transfer you the money. That's really what it should be, and that's what we're moving towards.
What about if someone rocked up to you and said, Simon, I want to acquire a book and I want to bring someone into the business to run it. You would fund both of those things.
Yeah, absolutely.
Yeah. Because for me, like, when I'm speaking to business owners that are, Joe, I want to chuck the kitchen sink at this business and make it work. Hiring is a growth lever, but I'm going to stretch myself. I'm going to be bootstrapped. For them, I always say, well, have you heard about these businesses out there where they can help you acquire a book? That way, yes, you're taking on more debt. However, you're actually taking on more of an asset as well. So the risk of hiring that person, let's separate the two, becomes a lot less. Because even if that person doesn't work out, at least you've now brought a new compounding trail book into the business that's going to somewhat cover them.
100%. Yeah. Look, so on a good or on an acquisition, if you fund through us, you'll be cash flow positive from day one. So let's say, for example, you've purchased $10,000 worth of monthly trail. Your loan payments might be $5,000. So then you've got this $5,000 worth of extra cash flow that you can play with in your business. The other thing is, like I was saying before, with the upfronts and the extra business that you can generate from an acquisition. I spoke to a broker recently and he'd just purchased a book he was an experienced broker. He really knows what he's doing. He went and bought a book for $180,000. I checked in with him 3 months later and I said, oh, how'd that acquisition go? And he said, yeah, pretty good. I said, all right, well, have you got any upfronts from it? And he said, yeah, I've written $60,000 in additional upfronts since I acquired the book. I said, wow, in 3 months. And he said, yeah, I'll have all my money back within 12 months. Plus, he's got this extra ongoing trail, this network of clients. So for him, it's worked out to be a really good investment. So, there is scope to pull off something like that. Not everyone will be able to. You need to be a good broker. You need to have good systems in place. But that's the sort of thing you can do. And that's how people get ahead and jump out of these kind of dead spots in the trajectory of being a broker by putting capital to work.
I like it. So to jump back a little bit, right? If you were starting McKenzies again, of your journey since doing that, right? What have you learned and what things would you apply in the business? Probably things that you've learned from speaking to brokers and seeing systemized, process-driven businesses, right?
Yeah, absolutely. Look, I think you want to get really clear on your LTV, so lifetime value of a customer. Understand that number, make it crystal clear. How much am I going to make every time I actually attain a new customer? And then you want to get really clear on your CAC, which is your cost of acquisition. So how much is it going to cost me to acquire that customer? And if those numbers aren't attractive and you can't see a clear difference in those two, then it's not a worthwhile business to pursue. If you do have a nice gulf and a nice difference, you can say, okay, well, it's super profitable for every customer I can attain. Well, if you're absolutely certain about that, the game is go and acquire as many customers as you can. And in order to do that, you're probably not going to want to bootstrap. You're going to want to add a little extra juice. And that little extra juice can come from, maybe an equity partner, someone who's going to invest into your business, or it can come from a clever funding solution like we're hoping to provide, or we're going to be providing to brokers.
Was there ever a time where you was like, I might go and present to the Sharks, see if they want to buy in? Because I'm sure there probably was that thought, right?
Yeah, I definitely thought about it. I mean, I had these investors who were fantastic guys. They still are fantastic guys who had a really good startup and they were about the same age, and they were keen to jump in and turbocharge it. At the time, I said no, and this is if I could go back and if I was in the same position now, I would have just said yes because you never know what can happen with a bit more capital and a bit more of a team behind you. At the time, I said, no, I got into this because I wanted to be in control of my own destiny. And, I don't think the offer I don't think what you're putting forward is that attractive for me. So yes, if I could go back in time, I would have said yes to those guys. And who knows if it would have worked out? Maybe it would have, but I know it would have been a bit more of an adventure because it would have turbocharged my business and it wouldn't have been, so much me alone in my bedroom trying to work out Facebook ads. It would have been more, okay, I got a team. Let's really pump this thing and see what's possible. So that's something that I would change.
So from what we've spoken about, right, there's two cycles to it. There's the turbocharging, funding up the business. This is me talking to your potential brokers, right? But there's also people that are at a different business life cycle. And, I've seen brokers that have really romanticized the idea of, I'll get my son to come into the business. I'll get my daughter to come into the business. But their son actually wants to be a truck driver. True story. So it's like, their business has been up, 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 and then it's kind of hit this peak, plateaued, and now it's on the way down. So people exiting their business is really going to be another benefit and solution you guys can offer. I don't know if you can talk too much to that, and I guess how you could assist.
Yeah, succession is a massive theme in the business. There's plenty of brokers who've been broking for 10 to 20 years, and now they're at a point where, they either want to pass it to a, friend, family member, or an employee, or they just want to sell the whole thing. I mentioned this before, but there is a huge range at which a brokerage can sell. And nearly all mortgage brokerages will sell on a multiple of trail. So it's best to just think about a multiple of trail when you're thinking about, okay, how much am I going to sell for? And it could sell for anywhere between 2 and 4 times. And, in the future, I'm sure we'll see higher multiples than that. So you've got this big gulf, and it can make a massive difference to your retirement and your life. If you're thinking about selling, say within the next 5 years, it's really important that you understand some of the key data and underlying metrics that are in your trail book, because that's exactly what the prospective purchaser is going to be looking for. And so you need to make sure that you know your numbers and that your numbers are super strong. Some of the numbers that I'm talking about, of course, the runoff rate. So if your book was left dormant, 3, 4, 5 years time, how much trail is going to be left? So if you can reduce that runoff rate by having a really good customer retention strategy, by offering great service, by checking in with people, then you're going to really increase the value of your book. Everyone's looking to buy a book where the trail is sticky, where their clients are sticky, they're happy, they don't move around. Similarly, with the age of loans. So, I speak to a lot of brokers who are burnt out, and they're thinking, you know what, I just want to throw the towel in. I know this book is valuable. I want to take a big break. Maybe I'll work again. Maybe I'll go work for someone else. I don't know, but I'm taking a break. We look under the hood of their business and we have a look at their loans, and it turns out, 60% of their loans are less than 2 years old. So that means they're in that clawback zone, and that's a real red, that's a red flag for a prospective buyer, because they're thinking, geez, I buy this thing, start getting hit with clawbacks. My trail gets wiped out. My clients are leaving. This is not a good look. What you really want is a nice spread of the ages of the loans. So if the average age of the loans is 4 or 5 years, well, that's perfect. It means that you've got a nice spread of loans that are 0 to 2 years, 2 to 4, and then, maybe 4 plus. That's really what you're looking for. So there are key metrics like this. What's your clawback rate like? What's your arrears rate like? What's the average size of your loans? Are you just writing loans all day and all night, but the average size of new loans is like 500 grand when the industry average is 820? It's like, you're doing yourself a disservice. Whereas, I saw in the Advisor recently released a list of top 100 brokers, and it said what their average size of new loan was. A lot of the guys up the top are writing $1 million plus, some of them 1.5, and their volume is not the actual number of loans they're writing isn't massive, but they're just writing big loans. They've got those sorts of borrowers, and it's not going to be for everyone. It does come down to your geographical location, but I tell you what, it's a lot easier to write. Often it requires the same effort to write a $1.5 million loan as it does a $500,000 loan.
Yeah. The person who finished 100 and the person who finished 99, the average loan size, the guy who finished 100 was, I think, half the size of the guy who finished 99th. So he'd done half the volume. You should look into that.
Yeah.
You talked previously there about the value of trail books increasing, right? Do you see there being a consolidation, I guess, bringing that people's lack of desire to sell their books might organically or naturally inflate the value because people are going to have to, give a little bit more to actually buy them out? Is that kind of where you see it going?
Yeah, absolutely. At the moment, simple fact of the matter is there's more buyers than there are sellers. And that's really driving up the price. There are so many brokers who want to acquire this recurring revenue and these clients that there's a lot of attention. Every time a book comes up for sale, there might be 10 interested parties for every book that's going on the market. That creates a lot of demand, and that really drives the price up. That's just the way it is at the moment. Is it always going to be like that? I'm not too sure. But certainly at the moment, we're seeing the prices just creep up because, there's so many people who want to buy these assets.
Fantastic. Simon, we'll just start to wrap it up here, but you've obviously soft launched the business as I did in October, get everything out there, get everyone feeling it and get people ready. But when are you really going live, and when will people actually be able to really take benefit from the service?
Mate, we are live. So We're starting to chat with people now. We've got a few people in the works who are looking for funding, and yeah, we're deploying funds as quickly as we can, and we don't expect to stop anytime soon. So if anybody's interested, reach out. Let's start a conversation and start talking about what's possible.
Thank you. Simon, thanks for jumping on, mate. It's been very good to have you on here. I think, the service that you're offering to the industry is really, really valuable. I know for a fact that I speak to businesses that will get a lot of value from it. So I'm really looking forward to continue this conversation, mate. Yeah, thanks for jumping on.
Joe, my pleasure. Thank you. I feel very privileged to have been on the show. Thank you so much.
Thank you very much, mate. Speak soon. Take care.